There's a state so small you could drive across it in under 2 hours that somehow led the entire country in bank branch closures in 2026, shutting down 64 branches while the press releases all used the same word. The word was optimizing. The state is Delaware, and it's not even the worst on this list. While everyone's been told that banking went digital and everything's fine, the physical banks have been quietly switching off the lights. Not everywhere. In specific states, in the regulatory filings nobody reads, the branches are vanishing. According to the FDIC, the U.S. had 4,462 banks as of March 2025, down from 4,577 a year earlier, and down from more than 30,000 a century ago. According to the Federal Reserve Bank of Philadelphia, the rate of bank branch closures has doubled since 2020, with total branches down 5.6% since the pandemic began. According to that same Fed research, there are now over 3,000 banking deserts in America, places with no physical branch within reach, affecting more than 12 million people. And here's the part the "everything's digital now" crowd skips. The people who lose the last branch in town are disproportionately low income, elderly, rural, and least likely to have the broadband or the comfort to bank entirely on a phone. In this countdown, we're exposing 10 states where banks are vanishing in 2026. Not the loud version with a financial crisis headline, the quiet one, where the only bank in a small town locks the doors and the nearest teller is now a 40-minute drive away. Subscribe before your town's last branch posts a closing notice. Like the video if your local bank branch closed and you had to find a new one across town or across the county. Let's break it down. Number 10. Texas. The Lone Star State where the distances are enormous and the bank branches keep getting fewer, which is a brutal combination. Texas was among the states with the highest number of bank branch closures in 2025, according to OCC filings. Texas has vast rural regions where a single branch closure can create a banking desert spanning entire counties. Texas has seen major institutions like JPMorgan Chase, which led the nation with 66 closures in 2025, thin their physical footprint. Texas rural communities increasingly rely on a single branch that, once gone, leaves no replacement. What's actually happening in Texas is that the same geographic scale that makes everything bigger makes every closure hit harder, because the next branch isn't across the street, it's across the county line. Sharp contrast. Texas and the digital banking pitch don't fit rural reality. The cities adapt to apps. The ranchland gets a banking desert. Same state, two completely different banking realities. Number 9. Illinois. The land of Lincoln, where the closures hit both Chicago neighborhoods and downstate small towns, two very different problems with the same cause. Illinois had 14 bank branch closures in the first quarter of 2026 alone, among the highest in America. Illinois was among the states with high closure counts throughout 2025. Illinois has lost branches in both urban Chicago neighborhoods and rural downstate counties. Illinois' population decline has given banks one more reason to reduce their physical footprint. Here's the Illinois problem in one line. A state losing residents is a state losing the foot traffic that justifies a branch, which means the people who stay lose the bank too. What residents notice in Illinois is that the branch closures track the population losses, compounding the sense that the institutions are quietly heading for the exits. Sharp contrast. Illinois and Indiana are neighbors. Indiana's steadier population supports steadier branches. Illinois' outmigration accelerates the closures. Same region, different demographic gravity. Number 8. Louisiana. The Bayou State with the second highest unbanked rate in America, where losing a branch isn't an inconvenience, it's a financial exile. Louisiana has an unbanked rate of 8.1%, the second highest in America after Mississippi. Louisiana's rural parishes are among the regions the CFPB flagged as banking deserts. Louisiana's combination of poverty and rural geography makes branch access especially critical. Louisiana residents in banking deserts face higher reliance on check cashing and payday services that drain income. Here's the cruel math in Louisiana. The people with the least money are the ones most likely to lose their bank and the most likely to get pushed toward the predatory services that cost the most. What's actually happening in Louisiana is that branch closures don't just remove convenience, they push vulnerable residents into a more expensive financial ecosystem. Sharp contrast. Louisiana and a wealthy suburb tell opposite stories. The suburb keeps its branches and its app options. Louisiana's rural parishes lose both. Same country, opposite access. Number 7. Mississippi. The state with the highest unbanked rate in America, where the banking desert was already a crisis before the latest round of closures. Mississippi has the highest unbanked rate in the country at 11.1%. Mississippi's rural counties are among the most documented banking deserts in America, per CFPB analysis. Mississippi has the lowest median household income in America at $44,966, leaving residents least able to absorb the cost of distant banking. Mississippi's banking deserts disproportionately affect Black and rural communities. Here's the Mississippi reality. When 11% of the state is already unbanked and the branches keep closing, the gap between the connected and the cutoff isn't narrowing, it's widening. What residents notice in Mississippi is that just use the app assumes a smartphone, broadband, and a bank account. 3 things the banking desert is specifically defined by lacking. Sharp contrast. Mississippi and a connected metro diverge sharply. The metro debates which app is best. Mississippi debates how to cash a check at all. Same digital era, opposite starting lines. Number 6. Pennsylvania. The keystone state that lost branches faster than almost anywhere, with 627 gone across its region during the pandemic era. Pennsylvania branches declined 9.8% relative to 2019, among the 5 steepest in America, per the Philadelphia Fed. Pennsylvania, New Jersey, and Delaware combined lost 627 branches in a single Fed study period. Pennsylvania has 17 branches flagged at closure-related risk in recent OCC filings. Pennsylvania's rural and lower-income communities saw banking deserts expand fastest. What's actually happening in Pennsylvania is that the closures concentrated in exactly the communities, lower income and rural, that the Fed warns can least afford to lose physical banking. Sharp contrast. Pennsylvania's cities and its rural counties experienced this differently. Philadelphia and Pittsburgh kept density. The rural counties became deserts. Same state, 2 banking maps. Hey, before we get into the top 5, the states we're about to cover are the ones where the branch losses have been documented in FDIC data, in OCC weekly bulletins, and in the Federal Reserve's banking desert research. If this has been useful, hit subscribe, because the next one is 10 American cities where the property tax bill just doubled, and you'll want to check the list. Like the video if your local branch closed and you had to drive across town or across the county to find a new one. Drop a comment if your town lost its last bank. Now let's keep going. Number 5. New Jersey. The garden state that lost branches at the 3rd fastest rate in America, in one of the most densely populated states in the country. New Jersey branches declined 11.7% relative to 2019, the 3rd steepest in America, per the Philadelphia Fed. New Jersey was among the states with high branch closures throughout 2025. New Jersey's bank consolidation accelerated as merger activity picked up in 2025 and 2026. New Jersey's high cost of operating branches on expensive real estate made closures attractive to banks. Here's the New Jersey irony. In a state where you're never far from anything, the banks still decided you were close enough to a neighboring branch to lose your own. What's actually happening in New Jersey is that even dense, high-income states aren't immune because the closures follow merger math, not population need. Sharp contrast. New Jersey and the digital pitch partly align. The young and connected adapt. The elderly residents who banked at the same branch for 40 years don't. Same state, generational split. Number 4. Maryland. The mid-Atlantic state with the 2nd steepest branch decline in America, where the federal adjacent economy didn't protect the local bank. Maryland branches declined 12.1% relative to 2019, the 2nd steepest in America, per the Philadelphia Fed. Maryland's federal workforce-dependent economy faced added pressure in 2025 with federal employment reductions. Maryland saw banking deserts expand in lower-income and rural areas of the state. Maryland's branch closures clustered, like elsewhere, in the communities least able to absorb them. Here's the Maryland problem. The state assumed its proximity to Washington made it economically bulletproof, and the bank branches closing in its rural and lower-income areas say otherwise. What's actually happening in Maryland is that even a wealthy, federally anchored state is watching its physical banking thin out in the places that need it most. Sharp contrast. Maryland's affluent suburbs and its rural eastern shore diverge. The suburbs keep their branches. The eastern shore loses them. Same state, opposite trajectories. Number 3. Virginia. The state with the single steepest bank branch decline in America, down 12.5% from its 2019 totals. Virginia branches declined 12.5% relative to 2019, the steepest decline of any state in America, per the Philadelphia Fed. Virginia's rural southern and western counties saw banking deserts expand significantly. Virginia's branch losses, like the national pattern, hit lower-income and rural communities hardest. Virginia's federal-adjacent northern economy masks the rural banking collapse in the rest of the state. Here's a quote that's been circulating on Reddit from a southwestern Virginia resident in 2025. "The bank's been on Main Street since my grandfather's time, and now the nearest branch is 35 minutes away, and they act surprised the town is dying." What's actually happening in Virginia is the steepest documented branch decline in America, concentrated in the rural counties where the closure means the difference between a functioning town and a hollowed-out one. Sharp contrast. Virginia's Northern Tech Corridor and its rural Southwest are two different states wearing one name. The North keeps everything. The Southwest loses the bank. Same Virginia, opposite outcomes. Number 2. Ohio. The Buckeye state that came in second nationally for branch closures in 2026, where the Midwest banking desert warning is becoming reality. Ohio had 41 bank branch closures in the first quarter of 2026, the second most in America. Ohio is at the center of the Federal Reserve's warning about growing Midwest banking deserts. Ohio's mix of struggling small cities and rural counties makes it especially exposed to closures. Ohio's bank consolidation accelerated alongside the national merger wave in 2025 and 2026. Here's the Ohio reality. The Midwest was supposed to be the stable middle of the country, and it's now ground zero for the banking deserts the Fed has been warning about. What's actually happening in Ohio is that the small cities and rural counties that anchored Midwestern stability are losing the branches that anchored their main streets. Sharp contrast. Ohio and the coastal digital banking story don't match. The coasts adapt to apps with broadband. Ohio's small towns lose the branch and the broadband both. Same country, different infrastructure. Number 1. Delaware. The second smallest state in America that somehow led the entire country in bank branch closures in 2026, with 64 branches gone. Delaware had 64 bank branch closures in the first quarter of 2026, the most of any state in America, despite its tiny size. Delaware, despite being a corporate banking capital on paper, is losing consumer branches fast. Delaware, Pennsylvania, and New Jersey combined lost 627 branches in a single Fed study period. Delaware's banking deserts expanded fastest in lower-income and non-white communities, per Fed research. Here's the Delaware paradox in one sentence. The state that half the Fortune 500 calls its legal home, the credit card capital of America, is the state where actual human beings are losing actual bank branches faster than anywhere else. What's actually happening in Delaware is the cleanest illustration of the whole story. The banks love Delaware for its corporate law and its credit card-friendly statutes, and they're closing the branches where regular Delawareans cash their checks. The corporate banking thrives. The consumer banking vanishes. Sharp contrast. Delaware's corporate registration business and its consumer branch network point opposite directions. The corporate side is booming. The branch side is collapsing. Same state, two banking systems, only one of them is for you. So there it is. 10 states where banks are vanishing in 2026 on the public record, in FDIC bank counts, in OCC weekly closure bulletins, in SP Global merger tracking, in the Federal Reserve's banking desert research. States where branch closures hit rural counties hardest. States where the unbanked rate was already a crisis before the latest closures. States where merger math, not customer need, decided which branches survived. States where just use the app assumes broadband and comfort that the affected communities specifically lack. The story banks tell is that this is all just digital progress, and for the young and connected, it mostly is. But the Federal Reserve's own research says the people losing their last branch are disproportionately low-income, elderly, rural, and least equipped to bank entirely online. The reason banks are vanishing from these 10 states is that a branch is the single most expensive thing a bank operates. And in a merger-driven, app-first era, the math says close the ones with the least foot traffic. The trouble is that least foot traffic usually means poorest and most rural, which means the closures land hardest on the people who relied on the branch the most. So the doors lock. The sign points to a branch 3 towns over, and the elderly customer who banked at the same teller window for 40 years is told to download an app on a phone they may not have, using broadband their county may not offer. That's what it really means when banks vanish. Not progress for everyone, progress for the connected, and a banking desert for the rest. If this helped, share it with someone who still drives to a branch to do their banking. Hit subscribe, because next we're breaking down 10 American cities where the property tax bill just doubled. Drop a comment if your town lost its last bank. And remember, the worst banking crisis isn't the loud one with the headlines and the bailouts. It's the quiet one, where the last branch in a small town locks the doors, and the people left behind find out that everything's digital now was never written for them.